Okay, so imagine that you want to construct a multi-billion-dollar corporate conglomerate in a country with one of the lowest violent crime rates on Earth. You want to operate out of marked office buildings with polished brass nameplates, issue legal business cards to police inspectors, and run a pension fund for thousands of full-time employees. You want to generate $5 billion a year from extortion, predatory loan sharking, and insider trading, while maintaining a public relations office that hands out candy to children during traditional holidays. Sounds impossible. And yet, for the better part of 7 decades, the Yakuza didn't just operate in the shadows of post-war Japan. They operated directly in the light, fully integrated into the financial bedrock of the world's third-largest economy. This wasn't an underground insurgency. It was corporate engineering at a national scale. To understand how a syndicate of this magnitude survived, you have to look at the structural preconditions of post-World War II Japan. In 1945, the country was a landscape of industrial ruin, rationing, and destroyed infrastructure. State capacity was crippled, and the official distribution networks for basic goods, food, fuel, clothing, completely collapsed. Into this total economic vacuum stepped the precursors of the modern Yakuza, street market brokers or tekiya and gamblers known as bakudo. They seized control of the black markets that kept major cities fed. They didn't just traffic illicit goods, they provided essential urban logistics when the state couldn't. By the 1950s and 60s, as Japan entered its economic miracle, these groups underwent a rapid corporate evolution. The state needed labor discipline to fuel its massive construction boom, and corporations needed protection against aggressive labor unions. The Yakuza stepped in as private enforcement brokers, managing dockworkers, construction sites, and real estate acquisition. They established a quiet, symbiotic social contract with the ruling political elite. In exchange for suppressing political radicalism and keeping street crime low, the syndicates were granted an unwritten social license to operate. They became a shadow utility company, extracting rent from the margins of Japan's economic expansion. At the center of this ecosystem was a unique financial mechanism, the corporate extraction loop, known locally as syndicate. Instead of relying on crude street-level protection rackets, senior Yakuza operatives bought small blocks of shares in major Japanese corporations, banks, and real estate firms. Under Japanese corporate law, holding even a single share granted the right to attend annual shareholder meetings and ask questions. The syndicate would research the personal scandals, financial improprieties, or off-balance sheet liabilities of company executives. The transaction was elegant and chillingly legal on its face. The syndicate would not threaten physical violence. Instead, they promised to embarrass the executive board during the highly publicized annual meeting by raising uncomfortable questions in front of institutional investors. To buy their silence, corporations hired Yakuza-affiliated consulting firms, subscribed to absurdly overpriced internal newsletters published by front companies, or awarded lucrative construction subcontracts to syndicate-controlled firms. The money entered the Yakuza ledger not as laundered cash from street corners, but as legitimate corporate consulting fees paid by publicly traded conglomerates. It was an extortion model built entirely on corporate governance vulnerabilities. The scale of this enterprise was staggering. By the height of the Japanese asset price bubble in the late 1980s, the National Police Agency estimated that total Yakuza membership exceeded 80,000 formal and informal operatives across dozens of competing syndicates. The largest of these organizations, the Yamaguchi-gumi, functioned essentially as a decentralized holding company based in Kobe. At its peak, police analysts and economic researchers estimated the Yamaguchi-gumi's annual revenue reached billions of dollars, comparable to a Fortune 500 enterprise. During the bubble era, the syndicates moved aggressively from corporate extortion into direct real estate speculation and banking. When Japanese real estate prices skyrocketed, property developers faced a major bottleneck: land assembly. In Tokyo and Osaka, purchasing small residential plots to assemble massive commercial blocks required unanimous consent from dozens of property owners. The Yakuza developed specialized land assembling fronts, using intimidation and economic coercion to force stubborn homeowners off valuable plots. Commercial banks, flooded with cheap capital, knowingly loaned tens of billions of yen to Yakuza-controlled real estate entities, using the inflated land itself as collateral. Sociologist Hiroki Inaba and researchers at institutions like Incite Crime and the UNOC have noted that at its height, the Yakuza were not an alternative to the Japanese banking system. they were one of its major institutional borrowers. When the asset bubble burst in 1991, Japanese banks were left holding an estimated $600 billion in non-performing loans. Reconstructive audits revealed that a substantial fraction of those bad loans were directly tied to Yakuza front companies that had no intention or capacity to pay them back. This was the breaking point. The collapse of the bubble economy destroyed the unwritten social contract that had protected the syndicates for decades. As the Japanese public endured a prolonged period of economic stagnation known as the Lost Decades, tolerance for syndicate-driven corruption evaporated. The state realized that international capital would not invest in a financial system where major banks were structurally tied to organized crime syndicates. In 1992, the Japanese government enacted the Act for Prevention of Unreasonable Acts by Organized Crime Group Members. It was a legislative shift designed to destroy the business model from the balance sheet down. Rather than targeting individual criminal acts, the law empowered authorities to designate specific syndicates as hazardous, granting courts the power to ban them from using their offices, entering specific commercial zones, or engaging in business under corporate titles. Subsequent municipal exclusionary ordinances passed in the 2000s and 2010s dealt the fatal structural blow. These laws made it illegal for any legitimate business or private citizen to do business with a Yakuza member, or even pay them money under extortion. Suddenly, a company that paid a Yakuza consulting firm could be publicly named, fined, and banned from capital markets. Bank accounts belonging to registered Yakuza members were closed overnight. They were barred from signing lease agreements, buying cell phones, taking out car loans, or purchasing health insurance. The economic machinery collapsed under its own systemic friction. Unable to hold bank accounts or execute legal contracts, the cash flow dried up. According to data from the National Police Agency, total Yakuza membership dropped precipitously, falling from over 80,000 members in the 1980s to fewer than 20,000 by the early 2020s. The average age of an active Yakuza member rose past 50 as younger recruits, seeing no financial path forward, abandoned the traditional syndicate structure. Senior members who once drove imported luxury sedans and controlled real estate empires were reduced to petty theft or street-level fraud schemes targeting senior citizens. The collapse of the Yakuza was not caused by a bloody police crusade or a victorious gang war. It was caused by total exclusion from the formal financial clearinghouses that had funded their growth. When the state made it impossible to bridge the gap between illegal revenue and the legitimate banking system, the corporate syndicate lost its economic reason to exist. Today, the brass nameplates are gone from the office fronts in Tokyo and Kobe. The legal consulting firms have dissolved, and the corporate extraction loops have been replaced by modern regulatory compliance divisions. The syndicate was built on a simple premise, that an illegal enterprise could run parallel to a national economy if it made itself useful to the system. But when the system changed its rules, the balance sheet cleared. The corporate infrastructure disappeared. The machine didn't adapt, it was simply priced out of existence.